You're fine. Don't worry. Okay. So the expected performance in when it comes to variance analysis or in any situation, it is called the budgeted performance, which is a point of reference that we are trying to make comparison. This is what we are trying to do, and this is what we actually get. And what's the difference between them? Okay. So if the final result differ from the budgeted plan, that means something different, something changed. Okay, and it causes the performance to vary. That's why we call it a variance analysis. So consider the following example. Let's take a look back at our Chewbacca Lemonade Incorporated again. Let's say the financial performance, the projected operating income is $3 million, but our actual operating income is $3.2 million. So how would you compare the financial results of the actual performance to the projected performance? It's the easiest conclusion we can make. Oh yeah, we make $200,000 more, right? But that's as much as we can glean on just by looking at this information. But how do we really compare the two period or the things that we plan to do and the thing we actually get? We know this information is not enough, right? It tells us too little of what we actually put effort into this in order to have a $200,000 increase in operating income. What has really changed? So if we were to look at the formula, we know the operating income equals to revenue minus CGS, that will give us gross margin, and minus the period expenses that will give us the operating income. If you look at the variable fixed cost approach, you will see that operating income equals to revenue minus all variable costs and all fixed cost. So if we want to compare these two subjects, the budget and actual, 3 million and 3.8 million, we now know that the operating income does not tell the whole story. This may come from a variety of reasons, right? It may come from an increase of revenue, right? Or it may come from a lowered CGS, or it may come from a lowered period expenses. Or you may think that the revenue went up, CGS also went up, and period expenses all went up. So without analyzing deeper, we really don't know what this $200,000 increase really mean without looking at the information deeper. So that's the motivation of the variance analysis. What has indeed caused the operating income or the end result to change, to vary? Is it because the sales price, right? The revenue effect, right? The sales revenue may be different, or the sales revenue different may come from the sales price. We sell more expensive, or the sales volume, we simply sold more, right, than what we projected to sell. Okay, and the variable cost may differ. The price of the input material may change. Okay, the price of the input labor may change, or the usage of material or labor may change. Maybe your company become more efficient, right? You can use the same amount of labor to produce more services and more goods, right? Or you can end up using the same amount of direct. Hold on, just my dog is chewing something that he shouldn't. Oi, Amane. Can you get the dog? He's chewing the carpet. See, put it back. And tell him don't chew it, and I'll hit him.
Look. No, can't do that.
Sorry about that. My dog is chewing on the carpet. Right. So not only that, even the fixed costs may differ. Like, for example, a firm may incur more or less fixed manufacturing cost, or even the non-manufacturing fixed costs may also change. So you see, when we compare two periods, or when we compare the things that we projected to a budgeted result, right? When we talk about budget in last week, we talk about the things that we projected, what we thought that we're going to produce that much at a certain price and sell the things at a certain price that will give us that projected financial performance. But in the end, something changed, which resulted in a difference in the financial performance, right? So that's what it means when it comes to talk about the cost of variances. So another way to understand the variance is by actual comparisons of a real world example. So let's just take a look at these two guys here. There's me here, and here's that handsome Hiddleston, the good-looking guy, right? He's like a 6'3", he's very tall, slender, handsome, with a British accent. Yeah, it's like, disgusting guy, from my perspective. Yeah. All right. So, how would you compare your Professor Me to Mr. Hiddleston, right? It's not an apple to apple comparison, you say, So how would you isolate the differences? I would make the case if I were as tall as him, right? And I might be as attractive as him, right? So I can attribute some of the reason why the people don't find me attractive because of my height, right? Or sometimes maybe because, let's say, the hair color, or just okay, I can try to go through to have some work done so I can look just like him, right? So you see, we try to isolate the difference, and the difference we can isolate, that's what we call the way to analyze the variance. So in this, I'm calling, if I'm as tall as him, okay, and something else different, so we can result in those, okay, some difference is due to height, some difference are due to hair color, some difference due to the accent, right? So that we then can have different kind of variance, the height variance analysis, the hair color variance, right? The accent variance, and also the last line is the income. He makes a lot of money, and I'm just like a poor university professor. So I admit there's no comparison to Mr. Hiddleston. You win, all right? So to make that comparison more sensible, we try our best to put the two things on an even keel, okay? And that's the approach of variance analysis. So comparing financial performance of the business would have a similar problem that if we do not isolate the differences. The trick is how we go about to isolate differences, and the technique is what we called variance analysis, okay? So this, if we go back, the word variance is actually derived from the word vary, right? It implies something has changed, something has varied. For example, the unit sales price has varied, which resulted into some change. The sales volume has varied, right? So we result that into the sales price variance or sales volume variance. Or the input material price has varied, so we result that as the input material price variance, and so on. So the change or the input that has varied, that has caused the difference in performance, that's what we called the specific type of variance analysis. Like you said, I planned to be just like Mr. Hiddleston when I was growing up. But guess what? Something changed. I didn't get there. So why, Mr. Lee, you didn't get there? Ask my mom and dad. Why? Right. Okay. Right. So the use of variances, you can see there are quite different uses because now we can isolate the differences. Okay. So if we see that the 3.2 million versus 3 million, we can somehow find that the input price actually went down. But what happened is that our usage of labor or our use of the material, right, become less efficient. Then we can assist those managers in implementing their strategy to enable them, right, to find out what has caused that exception, what has caused that differences. And we can allow them to focus their attention on the potential area they are not operating as expected. Okay, I want you to make 10 widgets in a day, but you were only able to make 8 widgets in a day. And what happened? Right. So highlight the area that have deviated most from the expectation, or variance can enable manager to focus on the area that is most critical, that caused the most problem. Right. Okay. So for that, okay, we can see that we can use variance to compare 2 periods, 2 subject, right, against 2 standard budgets, result that the different financial performance. And for this class, that you are, although introduce the variance analysis by looking at manufacturing industry, but you have to understand that the concept of variance analysis exists anywhere in accounting, right? It's just A and B differ. How do they differ? Or we projected we wanted to do this, we didn't do that. How do we differ? Okay, just it's in cost accounting, we usually approach it from the manufacturing company perspective, but that's not always the case. So when you do variance analysis, if you look into the textbook, you may see these type of terms: static budget variance, revenue variance, cost variance, flex budget variance, sales volume variance, variable cost pool variance, fixed cost pool variance, selling price variance, input price variance, overhead variance, efficiency variance, yield variance, and so on and so forth, right? It can be very, very daunting if you try to memorize the formula of each one of them. It's a hell. Don't do that. Even though it's an open book, open note exam, some students think, I'll just write down every formula, right? That's not the way to do it. No. Understand it, right? When we talk about variance, there's a subject here, right? So if the differences result in sales price, we allow sales price to vary. Therefore, we can call this sales price variance. If we allow the input price to vary and just look at the input price effect, right, on our bottom line, then we call it input price variance. All they're trying to do is to isolate the difference. What's the input price effect? What is the efficiency effect? Whether it's a favorable effect or unfavorable effect that cause our the cost to go up, right, or revenue to go down, either way. Okay. So the goal is not to memorize the formula, just like I said here. Okay, you must understand where these variants come from, okay, and you must try to understand what each variance imply. So a way to understand this, yet again, is by looking at this movie. Do you guys know this movie? The Talladega Nights, the Ballad of Ricky Bobby. Yeah, Shake and Bake. Shake and Bake. How many of you seen this movie? Yeah, Shake and Bake, baby. Shake and Bake. All right, so the reason why I tried to find that clip, I couldn't on YouTube. It's not on YouTube, so I don't know how to do it. But so I will just describe it to you. So this guy and his very good friend over here, they're just 2 dudes, right? They try to get into this NASCAR racing thing, but they couldn't, So he and his friend, they just serve as the pit crew. And just, you know what the pit crew is? The car coming, you just change the tire, add gasoline, and then do various things. So they were the pit crew of this losing team. And the driver didn't really care. So when the driver pulling to the pit stop, okay. So what happened to the driver to the pit stop and he start go there and eat a pizza and do something? He say, we're losing anyway. So he didn't want to drive. So they all encouraged Ricky Bobby to jump into the driver's seat, right? So in this case, what happened is that everything else remained the same. Only thing changed is the driver, right? So the driver varied. It caused the difference in the final result, right? So therefore, we called this is a driver variance. You see, the driver has changed. We control everything to be the same, right? Only allow the driver to change, and therefore we know that this is a variance caused by the driver. Right. So in variance analysis, when we analyze what is different, what has changed. Is everything else controlled for a meaningful comparison? Right. So that's the approach to doing that. So in the attempt to compare the actual performance and the budgeted performance, we know this is difficult to make the comparison before there are too many variables that are not controlled. So variance analysis, the objective is to do that, to identify and attempt to control the variables so comparison can yield the logical and sensible results. So that's what we do. So what we're doing is doing a combined, comprehensive example of my Star Wars themed example. We are going to look at Ewok Furs Incorporated. And so let's pull it up, the Ewok Furs. Let's give it a read. After we read it, you guys can start thinking about it. And then we can take a break after we take a look at the Ewok Furs. All right, so where is it? Where did it go? Ricky Bobby. I love that movie, especially that Sacha Cohen, that French dude in it. It's so funny. Did you guys see the news about Sacha Cohen? He crashed a right-wing party. Yeah, he jumped on stage and sing some really outrageous racist songs, and the people were singing along with him until the moment they found he's going too far and tried to chase him off the stage. It's funny as hell. Yeah, you guys should search it up. The Sacha Cohen. Okay, let me see. Where is my case? Over here. All right, let's try to read this together. I don't know whether I can make the reading mode. All right. So the reason I do this kind of comprehensive example is because I can put all the very different variances into one example instead of just, okay, this variance in this example, that variance in that example. That's going to take too long. If we have all the variances in one comprehensive example, then we can learn easier. All right, so let's give it a read. So Ewok Furs Incorporated, EFI, produces custom-made, highly sought-after wool work jacket that are made of lightweight fabric woven from real Ewok furs harvested from the curly, soft, plush, ultralight furs of baby Ewok as they shed before turning into adulthood. Wow, very nice. Right, since EFI's small operation is based on custom orders and the sales are generated through word of mouth, therefore EFI's only costs are in the manufacturing functions. EFI incurs no cost in other value chains functions such as marketing and distribution. Because of the custom nature of their operations, all units manufactured in April 2020 are sold in April 2020. In addition, all direct material are purchased and used in the same budgeted period, and there is no direct material inventory at either beginning or the end of the period. No work in process or finished goods inventories exist at either the beginning or the end period. So the reason why we set up this way for variance analysis, because variance analysis get really complicated if you have to deal with work in process items, because the cost of work in process items belong to the other budgeting area, the period. So it's a can of worm. And rarely in this beginning stage, you need to worry about that part. Okay, so that's why the questions are usually stated this way. So EFI have three variable cost categories. The budgeted variable cost per jacket for each category is as follows. So this is their budget, right? So the budgeted direct material cost, $60 per jacket. The direct manufacturing labor cost is $16 per jacket. And per jacket variable manufacturing overhead is $12. So the total variable cost making a jacket is $88 per jacket. So based on the current budget standard, this is their current budget standard, the following information on variable cost is obtained. The budget standard direct material cost is $30 per square yard of the woven fur cloth. The budget standard direct material usage requires 2 square yard of Ewok furs fabric per jacket produced, and the budgeted standard labor cost is $20 per hour, and the budgeted standard labor usage per jacket is 0.8 manufacturing labor hour. Okay, so based on the current budgeted standard, the following information on fixed cost is obtained. So the number of units manufactured is the cost driver for the direct materials, direct manufacturing labor, and variable manufacturing overhead. The relevant range for the cost driver is from 0 to 12,000 jackets. Budgeted and actual data for January 2020 is as follows. So they do have a budgeted fixed cost for production between 0 to 12,000 at 276,000. Budgeted selling price $120 per jacket. Budgeted production and sales is 12,000 jackets. The actual production of and sales is only 10,000. So we see something different. For now. They budgeted to sell 12,000, but they only sell 10,000. So in April 2020, the following information has obtained based on their actual performance. EFI have produced and sold 10,000 jackets, like it said here, and the sales price has actually increased to $125 per jacket. So they were selling 120, right? For some reason, they raised the price to 125, right? Maybe the management said they can get away with selling 125 and 120. That may result into the decrease of the sales volume. Instead of 12,000, they only sell 10,000. Is it because that the price up to 125? We don't know. So the actual direct material cost are $621,600, and the direct material cost per jacket, and based on the actual results over here, right? The direct material cost is 62 and 16 per jacket, compared with the budget direct material cost of 60. So their direct material actually went up, more expensive. The furs, I guess, more expensive than the originally budgeted. Maybe they have fewer baby Ewok to harvest. So less supply, higher demand. Right? Or the actual direct manufacturing labor cost of 198,000, and the direct material cost per jacket is 1980 per jacket, compared with the budget direct material cost of 16. So you see the direct material labor cost also went up. Right? So the actual manufacturing overhead costs are 130,500, and the direct material cost per jacket is $13.50 per jacket, compared with the budgeted direct material cost per jacket of $12. Not only that, the manufacturing overhead also went up. So the actual fixed manufacturing cost incurred are 285,000. So required here, let's produce the income statement of actual and the budgeted result. Compare the budgeted result over here to the actual result. And I already put it here on the handout, so you don't need to do this whole thing. You can just follow this and see how the budget result, we will also call it a static budget result, it's the same thing, to the actual result. But based on what we have read so far, we already know the difference came from various places, right? Their labor is more expensive, right? Their manufacturing overhead more higher, right? Even though the price is higher and the jacket sold is lower. So based on what we think, you already know that their operating income most likely will be lower, the actual result, because everything is went up, right? And the volume didn't catch up, even though the price come up a bit, right? So when we try to analyze this issue as a business, we cannot simply take a look and say this operating income has lower, it's all sales department's fault. Not really, right? Okay, it's the materials department's fault, right? So variance analysis, what we're trying to do, just like the lecture that I covered earlier, we have to find out the effect of each one of them, okay, by isolating, let's say, the overhead cost, or isolating the effect of the sales price, or isolating the effect of the sales volume. So we can see exactly, if we hold everything else the same, what will be the difference? Just like, if Mr. Hiddleston and I were both we both came from Britain, I might be as attractive as him, right? That would be so nice. My wife, she has a secret crush on Mr. Hiddleston. I know, because she bookmarked every movie, every one of them. And I saw her like a Netflix profile. She has like the Night Manager. She has all this like those Marvel movies. She has everything if he's in it. And then whenever like I was watching movie with him, we watched that the Night Manager together. You should see that. It's a great show. And so if the Tom Hiddleston is on the screen and I talk to her, and she'll be like, she'll be zoning out, somewhere. And I'm really jealous. It's like, Mom, Rich 45 is still jealous of some guy on the TV. Really sad. Yeah. She's not here. She's back in Japan, so I can say whatever I want. Yeah, I'm voicing my hate now. So yeah, it's nice to finally put Hiddleston in my lecture. And all right, let's take a break. Think about it. You can go ahead and take a look at the rest of the handout, right? And we will go one by one to solve the question in the handout, right? That's what we're gonna do for the next few hours. All right. If you want to print it out, take this opportunity, take this time to print it out. If you feel more comfortable working things on the printed material, take this time to print out the module, the handout, and we can do it together. All right, I'll be back. Let's come back 8:20. All right, that's I got a private to ask me to launch a poll to see whether indeed the final exam can be rescheduled. So let's do that. All right, let's launch this poll. Can the final exam be rescheduled to July the 7th, next Tuesday, 6 to 10? All right, so the poll is anonymous. So, but the result has to be unanimous, has to be the same. If any one of you said no, right, then the final will be on Thursday. Okay? Because July 7th is outside the original scheduled, the course time. I understand that some of you may want more time to study the variance analysis material. One day may not be enough, or one day and a few hours. So the choice is yours. Okay, so here is the question. Can the final be rescheduled to July the 7th, next Tuesday? No. Okay, no. If we got one no, that's no. So you see, many people said no. My intuition was correct. We're still voting. Well, we don't need to get the whole result because this is the result I'm getting so far. Right? Just like I said earlier, as long as there's one no, we can do that. So actually about half of our students said no, it cannot be done. Okay, and then this no can be for various reasons. Right? And maybe people have other classes they scheduled or other commitment they have made. So yeah, don't think too bad. But don't worry, I won't make the final too difficult. I'm not a monster. Some of you may think that I am after the midterm, but I'm not. Now, in the final, the length of the question or how many parts of the question you're going to be answer will be kept taken into consideration. So if you're going to answer multiple things in one question, and let's say if there are 5 things to calculate in one question, that will be counted as 5 questions, not just one. But the total will be about 30 questions. So it's not like 30 long questions. No. It's not. No, it's not. Okay. No. Don't worry about that. Yeah. And I will consider the length of the question into the final because the final questions are longer than the midterm type of questions. The midterm questions, the midterm chapters, those questions are, they are not that complicated like this final questions. The final question usually have a lot of words, right, to consider and a lot of information to sort through. So I will take that into consideration when I assign the questions. So you won't be seeing 30 this kind of long questions asking you to read. That's not going to be the case. Don't worry about that. Yeah. All right. Okay, so let's go back to our little thing here. Right. Okay. Let's see. All right. Let me pull up my my workshop mode. Okay. So for this comprehensive example, at the end of the class, I will publish the comprehensive note with the answers. Okay, so you can, if you have trouble doing this handout yourself, you can always consult the note, comprehensive note, that will have all the answers to these required elements here. So let's take a look at this here. So based on the actual performance gathered from these two results here, we ask, what is the difference in operating income? Has the EFI performed better or worse? So the actual result is what? It's oh shoot, this is not a good color. 14,900 actual, and the budgeted performance result based on the financial statement we put together is 108,000 operating income, right? Okay, so that's 108,000. So the difference between the two is a negative 93,100. Okay. Right. So based on this information, just on the operating income alone, we notice that they performed worse. Okay. But the problem with the variance analysis is that we have denoted this in the format whether it is a favorable or unfavorable result. Okay, so in this case, would you say this is a favorable or unfavorable result? What do you guys think? Is this a favorable result or unfavorable result? Yeah, it is unfavorable, but the confusion when it comes to variance analysis is this negative sign here. People usually go into, especially in the exam, negative, unfavorable. So double negative, is that favorable? You see? So the general rule of thumb, when it comes to compare variance analysis, you need to remember more income means favorable. Higher cost is unfavorable, because we're looking at the impact effect on bottom line. So more cost is always unfavorable, more income is always favorable, right? So if you have compared some results show you a lower cost, that will be favorable. So forget about the positive sign or negative sign. Okay, try to interpret what this number actually means. Does that mean higher cost than what we planned to do? Does that mean lower cost than what we planned to do? In this case, if we look at just the operating income, we get a difference of $93,100. But we know this is the actual and this is the budget. We performed worse. We made less. So that the result, it doesn't really matter it's a positive finance, don't look that way, because sometimes students do it this way: 108 minus 149. and they got a positive number and they got all confused and then is this favorable, unfavorable? Do not use the plus or negative sign to determine whether it's favorable or unfavorable. Always try to look at the effect. Have we made more money in terms of revenue, in terms of operating income, right? Or have the change, okay, made the result to change whether it's unfavorable or favorable in terms of our bottom line. So if we were to think over here, based on your opinion, what has changed in April 2020 to cause a difference in operating income? We know there are quite a few things. The sales volume differed. The unit selling price differed. The direct material cost per jacket differed. The direct labor cost per jacket also differed. And the manufacturing overhead cost also differed. Right. So our objective is to isolate these differences and to find out what they actually contribute to the difference. Okay. So the first thing that we look at is this effect. The actual result difference to the budgeted. This also called the static budget, remember? Static budget. Set in this. Okay? So the first variance that you learned is this. The difference between actual result to the budget result. Right? We budget something, but we didn't get there. Right? So this is called the static budget variance. Okay? As you see here, the static budget or master budget is based on what we projected to do. Right? But we didn't get there. To account for the variance, then we use this actual result minus static budget. We get a 93,100 unfavorable result, right? Okay, so that's what it's called at this level, highest level of variance. It's just a difference between actual and the static budget. Therefore, we call it the static budget variance. Okay, so you can see here a favorable variance usually denoted F, and an unfavorable variance is denoted U. Okay, for revenue items, U means actual revenue underperformed against the budget revenue, so that means unfavorable. For cost items, U means actual cost exceeded, right? The budgeted cost more, right? So let's go to the next items required. Produce a report of differences based on actual result and budget result. How do you account for differences, right? These is when the worksheet came into play. The worksheet is set up this way. Come on, clear my canvas. All right, good. Here. The way to do variance analysis the trick is setting up the worksheet, right? The worksheet is usually set up this way. You put the actual against the budget. Okay, by producing something in the middle. Okay, so here we can see now when we compare the information together, the units sold, the actual is 10,000 units. Okay, the static budget is 12,000 units. The revenue, right? This is at 12.5, right? And times this thing. So the revenue, total revenue is 1.2500. Okay, and here we have at 12, right? And that's 14400. So we have here 2,000 units unfavorable result. We sold less, the actual. And revenue here, we have 190,000 unfavorable result, right? Okay. The revenue, the variance is only this. And we work our way down. We start looking at the variable cost. And here we have a DM. DM here, we know it's 600. And the projected DL, the DM, direct material, is 720,000. So let's compare the two. What we get is 98400. This is favorable or unfavorable here. Direct material, we actually spent 621, but we budgeted 720. The difference is 98,400. Is this favorable or unfavorable? Favorable, right? Because it actually cost less. So it's favorable. Okay. And the DML, direct manufacturing labor, right? This is 130. Oh, no. It's not 130. It's 198. 198,000. And over here is 192,000. So the difference here is $6,000, and this cost more, 198 than 192. So this is an unfavorable result. And variable overhead. So some of you may ask, Professor, where did you get this information? It's already compiled for you here. You see? The budget result, the actual results already compiled. Right? So we just pull this information together and have something in the middle to compare. Right? So the variable overhead difference here is 130,500, and over here is 144,000. So here is more. The static budget spends more, right, to the tune of 13,500. So this, which one costs less? Actual cost less, right? So this is a favorable result, right? So total variable cost over here is 950,100, and over here is 105,600, right? The actually cost less, so to the tune of 105,900, a favorable result, right? Then you can consider the contribution margin. What's the contribution margin? Revenue minus the total variable cost, right? So of here, this minus this will get to contribution margin. So we have 299,900, and here this minus this, we get 384,000. So this one, okay, is it favorable or unfavorable? Yeah, contributed less, you see? So this is an unfavorable result to the tune of A4100. Unfavorable result. And therefore, when we look at this whole thing together, our operating income oh no, we still have fixed costs to consider, I'm sorry. All right, and our fixed cost over here, the fixed cost is 285, and the static budget, we budgeted 276. So our fixed costs actually go up more. So this is a $9,000 unfavorable result, and which resulted in our operating income. This is 14900, and here is 108,000. Right. So same thing here is 93,100 unfavorable. So the difference between these two, we call this static budget. Static budget variance. So what is the main problem here you see using the static budget to compare the performance to other variances? The problem is that there are so many of them different, right? So what we are trying to do is try to make sense of the differences by controlling the variables. So in the example above, we can attempt to control the first variable by allowing the sales volume to vary, which means the static budget, okay, is not that static anymore. Let's take a look at here, what that means. So if we look at this over here, right, the operating income is a result of many information that's changed, right? Actually, the direct material different. Direct material labor changed, variable overhead changed, variance changed, right? So let's just assume this. If everything stays the same, right, as planned, everything stayed the same, and we only allow the unit number to change, what will result look like? We only allow the units sold to change. Okay, static budget, we wanted to sell 12,000, right? So let's say it is, okay, let's assume, right, we sell only 10,000 based on these information. All the information remain the same. The variable costs remain the same, the direct material remain the same, the fixed costs remain the same. Okay, everything remained the same, right? Only the volume changed. The units sold changed. The sales volume changed. What the result would look like, right? So this is what we call the flexible budget, the flex budget, right? So the flexible budget means that if we only let budget to vary only one variable at a time, right? Okay. So that means the static budget is not so static anymore. Not so static. Because now we allow the unit sold to change. Okay. Therefore, it becomes a term called the flexible budget. Right. Okay. So what will this change? Right? What will this mean if we let the information to change? So if we choose to use the flexible budget here, let's use the worksheet over here again, following the same information. Okay. Now we are making the flexible budget. Okay. Use information. Okay, no. Use the costing information from the static budget and allow one thing to change at a time. So first, we allow sales volume to change. All right. If we allow the sales the volume to change, now what we are looking at is what we call the flexible budget. And that's use the same schedule, units sold, okay, variable costs. Inside variable costs, we have DM, DL, VMOH, the variable manufacturing overhead, right? And we want to take a look at the total variable cost. And after total variable cost compiled, we can get the contribution margin. And then consider the fixed costs. Then we get our operating income. So the units sold, now what we are calling the flex budget is we allow the sales volume to change to the actual volume sold. And we know the actual volume sold is 10,000 versus over here, that's called the static budget over here, is a 12,000. And the information that we use are the same. 144,000, and DM is, oh no, this, I forgot one line here. Unit sold in revenue. There's a unit revenue line here. The DM is 720,000 and the DL 192. Okay, here's 144. Right? And we have a total variable cost of 1056. And that gives us a contribution margin of 384. And the fixed cost 276,000. That gives us operating income of 108,000. All right. So quickly, we can use this same information to determine that's revenue. Okay, will be 1, 2, 0.00000, right? Because based on the information, and then unit price is the same as static budget, right? And use the same information from the direct material. Direct material is the variable cost. So we know based on the information provided, now we are looking at 600,000 and direct labor is 160, right? And 120, these are all variable, and total variable cost over here is 880,000. And the contribution margin we obtained is 320,000, and the fixed costs remain the same. Fixed cost doesn't change, right? Okay, it's not variable, so fixed cost remains at 26,000. And if we only allow the sales volume to change, right? Because this unit sold, right? This is the volume. And the operating income would be 44,000, right? So this is what we called the sales volume. Okay, by allowing everything to stay a static budget, only allow the volume to change. Okay, the operating income is 44,000 versus 106. So the difference here is 64,000 unfavorable. So that's the sales volume variance. Because by allowing the sales volume to change, right? Okay. Okay, so far so good? All right, so let's take a look at this deeper over here. Let's take a look at the inside the sales volume variances. So we have this information available to us. On one side, we have the flexible budget. Okay, and on the other hand, we have a static budget. How do we set up the flexible budget again? Do you remember? By allowing the units sold to change. This is 10,000 over here, this is 12,000 over here, right? And so inside, what we have is called sales volume variances, right? And based on what we obtained so far, the information, the operating income is 44,000 versus 108. And we know this is a $64,000 unfavorable result. So the sales volume variances is 64,000 unfavorable. But inside this sales volume variance, we know there's many number also differ. Right? The sales volume variances is a combined effect of the revenue, right, and direct material, direct labor, right, and all this difference that made up this $64,000 unfavorable result. Okay. Right, so when you see the actual questions found on the exam, right, sometimes they will ask you, what's this variance is, how do you account for the differences, right? Whether the revenue is favorable or unfavorable, whether the direct material is favorable or unfavorable, right? So that's usually the difference. So now we have information like this. If we were to look back, now we have actual result, right? And the actual result, we have units sold at 10,000. And then we have a flexible budget. The units sold also at 10,000, right? And we have static budget. The units sold at 12,000 units. Right? So we know that this difference over here, we already computed, right? This is $64,000 unfavorable result, because we got, using the flexible budget was 44,000 and using the static budget is 108, right? Okay, so how do we account for the difference between actual result and flexible budget? Now we are looking at, you see, the sales volume is actually the same, right? But there are many things differed, right? Sales volume is the same, other things become different, right? So how do we account for those? So here, you can probably imagine, right? The actual between the static budget, earlier we accounted between the actual and the static budget. The difference was how much? Let me see. Is 93100 unfavorable, right? Okay, so we accounted 64,000 unfavorable result due to the sales volume variances, because we only allow one thing to change, right? So this is SVBAR, right? So we do have about 29,100 unaccounted for, right? And how are we gonna call it then? Do you want to give it a name? We called it the sales volume variance, but look at over here. The sales volume is the same, so how are we gonna call it? It's very easy. We just call it flexible budget variance. So here we call it the flex budget variance. Right? Remember over here, actual to static, we call it a static budget variance. Right? And now we know this static budget variance is made out of 64,000, right, dollars unfavorable result of sales volume variance and 29,100 flexible budget variance. Okay? Because as you can see here, we already accounted for 64,000 that are due to the change in sales value, right? And over here, everything is static budget, static budget, static budget, static budget, static budget, static budget, right? But over here is actual, right? So the lump the combination of this whole thing over here, we call it the flexible budget variance. The difference between actual and flexible budget. That's called flexible budget variance. Right? So same thing. We can consider the flexible budget variance is over here. Right? The variance between the sales volume is actually 0. Right? So when we get the information from the statement that we got earlier, okay, let me just move this a little bit to the side. Let's just compare the actual and the flexible, okay? So when we compare this, we know is revenue, right? And the variable cost. Under variable cost, we have DM, DL, and the variable MOH, right? And then we calculated the total, right? Variable cost. And then we can consider contribution margin. Then we consider the fixed cost. Then we get our operating income. So from our earlier result, we know that revenue is 1.250000. The variable cost for direct material is 621,600. And direct labor 198,000. And the manufacturing overhead 130,500. The total variable cost is 950,100. And total contribution margin is 299,900. And the fixed cost is 285,000. And when we get the information from the flexible budget, we already computed over here. You see the flex budget, right? Every information except for the volume. This is the actual volume. And all the information over here, these are budgeted information, right? They differ because why? Because the volume is different. Because these are variable costs. So if the volume is different, they will all differ, right? So let's plug this information into over here. The flexible budget over here, right? So we have 1,200,000, and then the direct material is 600. It's 160, 120,000, and we have AA0000 for total variable cost, and the contribution margin is 320,000, and the fixed cost is 276,000. It's interesting because we budgeted at 276, but our actual fixed cost actually cost more, right? So again, you can consider this, compare them based on the flexible budget and the actual result, right? The flexible budget variance, FAVAR, the flexible budget variance, okay, FBVAR, and you can compute them. This is 50,000. Is it favorable or unfavorable? Are you sure? This is revenue. We made more. Yeah. You see, when you're dealing with large set of number, it gets confusing very quickly. Right? So always make sure that you track whether this is a revenue item or a cost item. Right. Over here, we have 21,600 unfavorable, 38,000 unfavorable, 10500 unfavorable, and 70,100 unfavorable, and 20,100 unfavorable, and the fixed cost is $9,000 unfavorable. Right. So it's quite interesting when you look at this. Even though we have a favorable revenue, right? But everything else is unfavorable. But this favorable revenue, if we take a look at it without calculating anything, so can you tell me where does this favorable revenue come from? The volume is the same, but we made more over here. Where is this the variance came from? The sales price, right? The actual sales price is higher than we budgeted for. So the sales price variance we can already see here, right? Without analyzing other stuff, due to sales price, right? We got more. But guess what? The costing information was so poor, right? So by looking at this, wow, yeah, we tried to up the sales price, but it still can't plug all the holes, punch through by all these costing information. They just cost too much. So therefore, at the end, we come up to over there, 29,100 unfavorable result as the flexible budget variance. Right. So if we were to put them together, everything together, right? So doing variance analysis, always do this. Actual, budgeted, and here you can call this static budget. Right? And in between this, we set up something called a flexible budget. Right? And how do we set the flexible budget? By setting the volume of the actual volume over here. Okay. And everything else, we got it from the static budget. Right? So the variance here between budget and flexible, between static budget and flexible budget, we know is due to the change in sales volume. So we know this is a sales volume variance. And between actual and flexible budget, we just call it the flexible budget variance. Okay. And then when everything calculated together, we know now the difference between these two, A and the static budget, is called static budget variance. And the difference between these two is the sales volume variance. And the difference between actual and the flexible budget, this is what we call the flexible budget VANCE variance. Right? Okay. So sometimes we call this level 1 analysis. Sometimes you will see from time to time. And can you tell me what's the level 1 variance? Level 1 variance is just tell you what's the difference between what you planned and what is actual. That is a level 1 static budget variance. Right? And then level 2, it goes into whether this is the sales volume variance or flexible budget variance. Right? And we know, based on what we compiled so far, these numbers change, right? Let's say this first one is the unit. This is the actual unit, right? This is the budgeted unit, right? And then all the other information, the actual information. But over here, quite an interesting result, what we see is here is the budgeted information using actual sales volume. Right? So that's what the flexible budget is. Okay, so far so good. So let's go up to see the information we gathered so far. Right? You'd be surprised that after we come up with flexible budget variance, now we actually understood that this 29,100 flexible budget variance between the actual and flexible budget, they give us a slew of results, right? Okay. Now we can consider very, very early on, that's this, like $50,000 favorable results are the direct result from changing the sales price, right? Because the volume remained the same, right? So the result that we got from changing the sales price, this is called the sales price variance. Very intuitively, right? And then the result that we get over here, the direct material and the flexible budget, remember the information here, this is based on the actual volume, right? This is the actual volume. This information is based on actual volume, but using the information from the direct material, right? So in essence, we control the volume, right? The volume is now the same, 10,000, but guess what? The direct material input price is different, right? On the flexible budget and on the direct material. So the difference here between the flexible budget and the actual, this is what called direct material variance. DMVAR. And over here is the direct labor variance. Here, variable manufacturing overhead variance, right? And okay, fixed overhead variance. And we are not looking at this one, these two, because they are just they are calculating items, right? Only these are costing items over here, and plus this fixed cost, right? So you see, we come up to this step without using any formula at all. I'm not showing you that a formula actual minus and times whatever. We have not used any formula. We just lay out the table, try to understand what is actually happening behind the variances, right? But a lot of times students want to do it a different way, a more complicated way, and how they do that is okay. They would come up this, okay, the sales price variance equals to actual selling price minus budgeted selling price times actual units sold. Some people would try to memorize every variances using this formula. Okay, each variance there's a formula. Each variance a formula. I tell you, if you do it this way, it's not a good way, because you will never understand what's the structure, the mechanism behind the variance, why things differ. So that's why I elected to choose to show you the graph, right? And so you can compare and see where the variances came from, right? So we have static budget and a flexible budget. The change is the volume. So we call it sales volume variances between static and budget, right? And between flexible budget and actual, now the volume is controlled, right? Now we can see under the same volume, there are several information that we can compare, right? Under the same volume, we allow the price to change. So we know that's called the sales price variance. Under the same volume, we allow the input material price to change, the DM, right? So we know that this 21,600, the differences actually result to the direct material, right? So compared to the very, very early way of comparison over here, if we would compare actual to static, right? When we compare the DM, we know it's unfavorable, right? But we still do not know whether this actual to static budget, this unfavorable variance or this favorable variance may come from whether it's a volume effect or price effect. You see? Because here, the actual is selling at 10,000. The static budget is selling at 12. And the price is different. Okay? Right? So it's very difficult to compare these two. But when we put on a flexible budget, when we put on a flexible budget here, control the volume at the same volume as the actual, now we can lay out the different variances based on the same volume, okay, with a flexible budget volume. So in variance analysis, this is the first step that you have to remember, right? How to put together the flexible budget, right? Once you start putting together the flexible budget, the following things naturally just flow through very, very easily. They just flow into the picture like that. And then you can, after we finish this level 2 analysis, we can go on to analyze even more um, the different variances that we can look at. Okay, so far so good. Yeah. Okay. So you guys look very tired. Are you guys tired? Let's take a break. Oh, it's almost 9:20, right? Okay, let's come back at 9:30 and I'll try to wrap things up. All right, let's come back to class if we can. Okay, I promise you, we're almost done. Really, you know, it's. I don't mean to make you suffer. It's just we naturally have to digest through so much material for the summer class. Right? Believe me, I try my best to make cost accounting interesting, but you know, by now, you don't need me to tell you it's difficult to make accounting interesting, right? No, I don't know why you guys choose to suffer. You could be outside, you know. I guess COVID-19, you can't do anything anyway. But a general rule of thumb, you know, I have really a tremendous respect for accounting students. You know, you could be outside partying, but no, you're taking my class. What's wrong with you? Right. Right. Okay, so last session we have figured out the sales volume variances and flexible budget variances. And we know inside the flexible budget variance, there are a lot of little variances out in there. All right. So in the level 2 analysis, we know there's something, it's called the sales price variances, right? Yeah, we can compare the result using the chart, actual, right? Static, flexible, and compute all the different variances on the chart method. Or once you understand it, you can come up this kind of formula yourself over here. The sales price variance is equal to actual selling price minus budgeted selling price times the actual units sold. Because that's exactly what we do on this right-hand side here, right? Okay, this over here, this information and this information, when you minus, when you compare the two, you get 50,000. But it is exactly the same as if you say 135 minus 120, right? That's the sales price, right? Times the actual, right? Volume sold. Then you will get same thing, 50,000. Same, right? So if you look at the rest of these, all the variable the cost, you get the same thing, right? The actual variable price minus the budgeted, the variable costing price and times the unit, right? Of your budgeted, right? The information times the actual volume information, right? You see, how do we get this? Remember? The budgeted price times actual output over here, right? Actual. Right. So that's how you come up with the information, right? With all the different variances. So you can see over here the account for differences in cost, right? But however, there's one thing more that I want to delve into before we call it a night. And let me see, let me move this up. There's particular things that still bother us. The problem is that the direct material cost, DM cost. We know the DM cost come from what? The DM input price times the DM usage, right? Same thing as labor, DL, labor input price, so $1 per hour, right? Times DL usage. This is actually like hours used. Right. So from this point perspective, we know the DM, the direct material variance, is not as simple as it appears. Just like when we look at the static budget variance and flexible budget variance, is not as simple as it appears, right? Because in this direct material variances, we know the input price may vary. The input price may go up while the usage go down, or both go up, or both go down. We don't know what actually made the change, right? So that's what we called the direct material input price variance if we control the usage. And same thing, if we control the input price and allow the usage to change, we call it the efficiency, the usage variance. And how do you calculate that? You can see this over here, and I won't bore you with the actual calculation. I'll give you the end result, the comprehensive notes, right? So you can go over it yourself. I'm already losing half of you here. So the rest of the time, that's I want to talk just to discuss with you that what's the finals gonna be like. And earlier, I've already asked how many questions actually there will be, and so the actual questions, the number of questions will not be 30 because I have to calculate in how many little questions each the long list question have, right? So I have to take that into consideration. But my general guideline is that you already been through sort of hell in midterm. It is hard, I know, and I don't plan to make you suffer more for the final. So just based on my observation, and I think the final will be easier. And I usually like this way because if I make the final my midterm too easy, and student usually just hey yeah it's easy. No, so it's good that you stayed with the class, and the final will not be as brutal as the midterm. If you studied, if you follow the material, you will do fine. And for those of you still struggled, you can go ahead and do the little mini case on transfer pricing that we set up. The calculation of the transfer pricing is very similar to what we have, the example we gone through in the international setting, right? And you have to conclude, right, what's the transfer pricing set at a certain point, the effect on the company's performance, and what does it mean operational wise, why the company motivated to do certain things and that, right? And so with this whole thing that I'm very comfortable to say that if you pay attention to our entire series of class, you're pretty good with cost accounting. And there's really not much else to learn. Others stuff you should be able to handle as they come, right? The most important part is after you take this class that you understand how to take a look at the accounting questions. You no longer be confused with accounting terms. Costing terms, you are not confused anymore, right? You know what the inventoriable cost is. You know what is a capitalized cost or capitalized expense is. You know what is ratio, what is margin, what is percentage. You know these things, right? And you are able to think critically as an accountant. And that's the purpose of these cost accounting education, to train you to become a real accountant, not just a mechanical machine, try to memorize formula, calculate different things, right? So you may notice that if you ask me for extension, try to do certain things, I will always give the extension because it's more important that you try to do it rather than you do it right for the first time. If you do it right for the first time, that by using various methods, it's fine, it's good, but then what I really want students to do is spend your time to study. We already have very, very little time studying, right? Try to understand the material. So the more time you spend, try to get into this material, the better it will be. And I hope this class opened the door for you for future accounting material. You should not be scared away, right? You know process costing is complicated, but you're not scared anymore because you know what it is about. And you know if process costing is not taken care correctly, and the company may use that to manipulate, right, their WIP, right, inventory valuation. And that WIP inventory valuation affect the cost of goods manufactured and affect cost of goods sold and affect their net income, right? So those are the things, the important things for accountants to know, right? It's not just the calculations. You know the impact of things if they are changed. And just like the things we are here, if we just go through the mechanical calculation of transfer pricing, it's not very difficult, but the hard thing is to understand why certain decisions are made, right, in cost accounting setting, right? Okay, so you know, even though that on the surface the question may look complicated, but if you understand the principle, then it should be easier for you to solve. So I will upload the comprehensive note for variance analysis. Make sure you go through the examples and practice questions tomorrow, right? For the transfer pricing and the variance analysis. I can imagine that these two chapters probably will these three chapters, actually three, four, yeah. The later chapters will probably account for a lot of questions, right? Okay, thank you very much. Have a good night and good luck on Thursday. We're gonna have a 4-hour exam, very long, right? But if you practice, you should be able to finish like in 2 hours or so, right? Bye. Yeah, yeah. Change now it's 30-30, right? You can change it to 20-40, 40 on the final and the 20 on the midterm, but you must make that decision before the final is given. Okay. All right. So it's the choice is already on iLearn. Okay. Just go to iLearn. If you want to make that choice, let me just indicate to me. So when I compile your final grade after your final exam, and I will know the weight distribution. Okay. Oh yeah, and by the way, I'm going to after the final exam over the weekend, I'll compile your grades. Right? I'm not perfect. I may make mistake transcribing the grades. Right? So keep a close eye on your own grade. If I make a mistake, let me know, and I can correct it right away before I submit the final grade. All right. Bye. Yeah. Huh? The chapters? Yeah, I think it's already listed in the syllabus, right? I don't really remember of the top of my head, but it's just the chapters that we covered after the midterm. Yeah, after process costing, you won't see process costing for a while. Wow. Okay. Right. Any other questions? I guess no. Right. Bye. Bye.